Yeah.
Order filled. Check us out.
You know what time it is.
This is a Mighty Soldiers exclusive.
Yeah. Let's get it. Let's get it.
What's up, guys? Andy with Mighty Soldiers Trades. My camera is blurry again. I don't know what's going on with this thing. The focus is perfect. I'm loving it. But anyways, guys, we're back with Gianni DePolce here. I'm dropping my pen. It's a good start to the show. I'm having fun. I think Gianni's probably laughing in the background here at me messing this whole thing up. But I'm just going to bring him on because you can see him laughing at me then. I brought you on and then took you away for a second, Gianni. What's going on, man?
Not much, man. How you doing?
I was doing good when I had my pen, but now it's on the floor. And yep. So I have a squish ball though. So that does it.
Yeah, right on.
So Gianni, I was talking to you about this before, man. Price, basically, if I can say it right, when I try to say it live, it doesn't come out right. When I have it in my head beforehand, it's there. It's all together. Price, it's easiest for price to react from where price is currently. And what I mean by that is that, we have these supply and demand zones, and we have this range, and we have these micro supply and demand zones throughout, near-term supply and demand, support and resistance. And what that means is there may not be much resistance here or here. We might get a little speed bump, and then we can just fly right through. If we get enough momentum to carry us through, I know some people don't like that word, but it does apply very well. That we can just take right through all these zones really quick, maybe even the nearest real, let's call it real supply and demand zone. So what I always say is, we can't just trade wherever we want, even though I arrogantly do so every single day. But I just wonder, what's your take on this?
Well, Andy, that's part of what makes a market, what you just described. You're going to trade the zones that you want, and then the market's going to tell you whether you're right or wrong. But you're talking about supply and demand and support resistance. There's also I know a lot of old pit traders use formulas to calculate like the pivot points, and then the trend indicator points and whatnot. And I found those are meaningful on the intraday level as well. And then if you calculate your pivot points for the week, then those are important within the weekly bar or candle. So. Yeah, man. I mean, at the end of the day, I think we saw last week a textbook example of that. We had a false break lower and a pretty mean short squeeze into the close on Friday that brought us up to the highs of the week and the month on the equity indices. That's bullish price action. Pretty good start to the day or to the week, I should say, here on Monday so far as well. So, we're not totally golden yet. We still have some resistance to take out here, but I think bulls are starting to make their case pretty strong.
Okay, so what I did this morning, Gianni, is I saw some I guess I can call it near-term weakness.
Yeah,
I waited for the pop this morning, and then I shorted that, got some brief, quick profit. I in my mind, I know that I'm going against the trend, or anyways. So I just said, hey, I'm willing to lose this much money. I'm going to stick to this stop. I'm going to be patient, and I'm not just going to start adding into it if it starts turning against me or something like that. And I think that's what most new traders do is as soon as it goes against us, we want to add and force it into our favor. And that is one of I believe that's the opposite of pumping. Pumping is where somebody is illegally like pumping and inflating the stock price, and then they intend on dumping it on whoever, right? But I think that averaging down is the opposite of pumping, because that is when stock will move fast, but it will move fast against you rather than in your favor. So,
yeah.
But yeah. So, anyways, I got that, and then I went back in and got long later because it's just you got to trade what's in front of you and what opportunities we have. And I was talking about it earlier how sometimes I do that, and it's like, oops, man, I had it all right this morning. I decided to change my plan, change my thesis up, and I'm looking at this. I don't know what happened. Sometimes I'm right, sometimes I'm wrong. And that's what you were saying. It's all about like what our plan is with the market and what's the market going to give us in return.
Yeah.
But it all comes down to our reaction. So all that long-winded, how do you manage your positions when you get into this and it all goes wrong? When you grab it at the wrong spot, when it really accelerates the moment you touch it, or like how do you manage that, if you don't mind?
Well, like in the futures or cash market, because I actually treat them a little differently.
It's up to you. Whatever you want.
So in futures, I really have to look at the intraday levels. And if I start taking out, like if I'm short and I start making a higher high, I just say, hey, my timing's off. I need to restart this trade because, futures is a market you really can't afford to stay wrong for long. And when it comes to cash, and I'm wrong, I usually wait until the very end of the day to basically trigger my stop. So I actually don't put any good to cancel stop losses on my cash market trades, whether I'm trading stocks or ETFs. In that case, I'll actually wait until I'll when I put a trade on, I'll set a price alert like at or below the certain threshold, and then if it triggers during the day, I start paying attention, and then last 15 minutes of the day, I'm really paying attention. Like, hey, are we below this stop level of mine? Because I've seen it time and time again where we see that intraday drawdown and rebound into the close, and I hate being whipsawed out of position. So I think trading at the close, there was a saying years ago that was pretty prevalent. It seems like I don't see it as much now, but I used to go, rookies trade the open, pros trade the close. But I think that's more, that obviously doesn't apply for day traders and, arguably even swing traders. But for most people, that's a really good principle because most people are not day traders or swing traders. Their time horizon is a little bit longer. So yeah, usually I'll know by the end of the day if I'm wrong and it's time to bail on the position. And the closing price is the most important data piece of the day. So I usually let that tell me whether I'm going to be right or wrong.
Yeah, I believe that I'm much better at trading against the amateurs in the beginning of the day. I fit in with them very well. At the end of the day, this power hour, I don't know what happened to it, where it went, and what what they're talking about. Because when I trade the close, that is the most reactions that I get to my orders. It almost seems like I can throw out anything, and there's going to be somebody to slap me really quick and say, "No, you're not just going to take this money this easy." What do you think of it, Andy?
Well, Andy, it's interesting. If you look at an intraday volume breakdown, pretty much any security, I think this principle holds pretty true. You'll see a big spike for the first 30 minutes of the day, and then the last, 30 to 60 minutes of the day. But that time period between like 10 a.m. Eastern to like 3:30 p.m. Eastern, I mean, there's not a lot of volume. There is obviously, but relatively speaking, compared to the open to the close, that's why that saying, rookies trade the open, pros trade the close, I think exists. And then you have all the algorithms, like, if there's a program that says, hey, I want to buy, one standard deviation above the mean or whatever. Well, you're not going to know until you obviously get that final print. So, yeah, the most success I've had, and everyone's different. You have to find the plan that fits you the most. Some people like to fade the opening gaps of the day. I know a lot of people that do that really well. But me, I tend to do better when I transact at the close, especially in the cash market.
Well, either way, guys, make sure you pause the disclaimer at the beginning. But, the one thing that I've learned over and over in my trading, and everybody that's successful at all is probably going to say the same thing: patience. Patience pays. Patience in getting into the trades, patience in how to even work the trade if you're in it. If you're building a position, building that position too fast is not going to work out too well for you. And I always say it now, is just understand that this is a range, and this is not just this is going up today or this is going down today. These are the ebbs and flows of the market. Are you concerned at all going into this Fed deal? I guess groceries and stuff has not cooled too much. We do see that we probably will head towards that 2% eventually. Do you have any thoughts on that?
Well, let me actually share a chart. I have a bar chart open here, and I can. I think really when it comes to inflation, it all comes down to crude oil. So let me get this chart open here, and let's see.
One thing I did not look at crude today, but we had pulled back quite a bit, I believe.
Yeah, it's down a little bit, but here it is. But I still like the idea. Last week looks like we completed a higher low, and apparently I'm not logged into my account here, but that's okay. And let me actually I want to put the commodity channel index on this. So let's see, CCI. There we go. Add. Let me just raise that up so you can see it. So last week we were coming back down. We dropped below that gap. We filled that gap. That's not really what I wanted to see. But then we, formed what could be a higher low. I think that's pretty bullish price action, but now we're fading a little bit here. So we'll see, still have an hour or two left before we settle in crude oil. But, you're asking about inflation. That's why I brought up crude oil. It's the primary driver of inflation expectations. And I don't think that the story is over yet. So, we had some, but they had the core PCE come in like mixed. They had some increases at certain intervals. Other intervals were like, normal, or like became an expectations. But it's not just the rate hike this week, Andy. We have the unemployment numbers at the end of the week, and there's something in economics called the Phillips curve, and it posits that there's an inverse but stable relationship between inflation and unemployment. So basically, as long as the job market remains resilient, we're seeing an uptick in layoffs, from corporations, but small businesses and whatnot are still hiring generally. I mean, I drove down, you know where Vreeland is. I was driving down Vreeland yesterday, and there was hiring signs at the local steel mill and at the rail yard. So there's still hiring going on, and those aren't bad paying jobs. So there is that out there. So if inflation doesn't markedly come down, I don't see a change in trajectory from the Fed. So, to me, I think the big thing is if crude oil, basically starts falling below 72, I think, you're right. We probably will get back to that 2% mark. But if we're above the 72, 74 zone, I still think we need to be aware that, this inflation story might not be over quite yet.
And then we also have, the bank story still, where with the, with what SBF or whatever it is, and then also on top of that, we have the commercial real estate with Charlie Munger recently saying it's not as bad as 2008, but we still have some concerns with that with banking, and then the Fed. I think they're kind of just counting on that to take care of inflation for them a little bit now. They're just, I don't know.
Yeah, I mean that very well could. That very well could. Their goal on tackling inflation, the Fed's being attacked from a couple areas right now with their monetary policy goals. Like you have the whole situation in Russia and Ukraine, and then Taiwan as well. War is inflationary. I think we've forgotten that. But, when the Iraq war started and the Afghanistan war started, like that's when oil prices shot up in the mid 2000s, right? And then actually when Russia invaded Ukraine, we came down. That's when oil peaked. It peaked that month in March 2022. But I'd keep a really close eye on the whole situation in Ukraine and Taiwan over the next month. And if it starts to tick back up, I think it's going to be bullish for commodities. And regardless of whether there's issues with commercial real estate, historically the Fed will stand to provide liquidity if there's an escalation in geopolitical tension. So. I think there's a lot of moving parts right now, but I think we're going to have our answer soon. And I would say at the latest by the end of second quarter when it comes to inflation. But what else did we have last week too, Andy? GDP came in positive again, lower than expectations, but everyone was saying we're going to be in a recession this year. Well, Q1 GDP was positive, so here we are, and stocks are coming off the lows. So.
And I believe one of those pieces of the puzzle you just talked about is the oil prices. And basically, if we get those oil prices start ticking back up, that's going to put a strain on overall prices everywhere, especially at the grocery store and stuff. So that's going to have the opposite effect. Do you see any of this really bullish for the market or bearish for the market overall? I mean, it's really just.
I still like the bullish case for stocks. I mean, just because. Nobody really likes stocks right now. I've been pretty constructive on stocks all year. People thought I was crazy. Like, we're gonna have a recession. I said, so what? I don't know what that has to do with stocks, but I think a lot of that's priced in. There's a massive short position that's unwinding. There's like some of the largest net short positions in stocks in years right now, and I think the pain trade for equities is higher right now. At the beginning of the year, I had an upside target in the S&P at 44 to 4,600 by June, so we're not too far away from that now. So let's see what happens. But I think the pain trade is higher, and rising rates historically have been bullish for stocks. They'll keep raising rates until something breaks. But if that didn't break it last year, then they're probably going to have to be a little more aggressive or figure something out. But I think the bigger story is that money's leaving the bond market, and it has to go somewhere. It's either going to go into stocks or commodities. So capital is like matter. It's never created or destroyed. It just transfers from one asset class or security to another.
That is beautiful. Yeah, guys, I want to make sure that you you follow Gianni on Twitter, and basically, do you still have your letter?
Well, yeah, I published through Benzinga and through MMA Cycles. So yeah, I published the Mercator letter, which was my flagship fund for about 5 years. But people wanted me to basically implement that for them, so that's what we did.
Cool. So check that out at Benzinga. And what's MMA Cycles?
MMAcycles.com. Yep.
MMAcycles.com. Yeah, check that out, guys. Gianni, thanks so much for joining us. I really appreciate your commentary. You helped me to open my mind and see these things a little more clearly, because I'm often zooming way into the charts and ignoring a lot of stuff. So
it's always a pleasure, Andy. Thanks for having me on.
Thanks, Gianni. Have a great day. Thanks, guys. Appreciate it.